Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Axsome Therapeutics Inc. annual report. Axsome Therapeutics Inc. offers a diverse range of products and services to manage various central nervous system (CNS) disorders. At the commercial level, the company provides three main therapies: Auvelity for major depressive disorder, Sunosi for excessive daytime sleepiness in patients with narcolepsy or obstructive sleep apnea, and Symbravo for acute migraine treatment. In addition to these commercial products, Axsome Therapeutics is also developing several investigational treatments. These include Axsome, a potential therapy for Alzheimer's disease agitation and smoking cessation, which has completed phase III clinical trials. The company is also working on Axsome, a treatment for narcolepsy that has successfully completed its phase III trial. Furthermore, Axsome Therapeutics has several other investigational products in various stages of development. These include Axsome, a potential therapy for fibromyalgia and other conditions, which has also completed its phase III trial. Additionally, the company is conducting phase III trials for solriamfetol to treat attention deficit hyperactivity disorder, major depressive disorder, binge eating, and excessive sleepiness associated with shift work disorder. The company's research collaboration agreement with Duke University aims to evaluate Axsome in a phase II clinical trial for smoking cessation. With its focus on CNS disorders, Axsome Therapeutics is committed to developing innovative treatments that can improve the lives of patients suffering from these conditions. Axsome Therapeutics, Inc.'s stock price has experienced a significant surge of 37.51% in the past year, driven by several key events that have captured investors' attention. One major contributor to this growth is the company's robust commercial performance, with total net product revenue reaching $638.5 million for the full year 2025, representing a 66% year-over-year increase. The strong sales of Auvelity and Sunosi have been particularly noteworthy, with Auvelity net sales increasing by 74% year-over-year to $507.1 million, and Sunosi revenue up 32% year-over-year to $124.8 million for the full year 2025. This impressive growth has not only exceeded analysts' estimates, but also solidified Axsome's position in the market. In addition to its commercial success, Axsome's pipeline advancements have also generated significant interest among investors. The company's acquisition of Axsome in November 2025 has expanded its epilepsy pipeline, while the upcoming Prescription Drug User Fee Act (PDUFA) target date of April 30, 2026, for Axsome in Alzheimer's disease agitation is anticipated to be a key driver for investors. Furthermore, analysts have reaffirmed their positive ratings and raised price targets for Axsome Therapeutics following its strong Q4 and full year 2025 results. The settlement of patent litigation with Alcom Laboratories Limited, related to Sunosi, has also reduced legal uncertainties, contributing to the overall positive sentiment surrounding the company's stock. Overall, these events have collectively contributed to the substantial increase in Axsome Therapeutics' stock price over the past year, making it an attractive investment opportunity for those looking to capitalize on its growth potential. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Axsome Therapeutics are multifaceted and influenced by various factors. One key driver is product sales, which have been impacted by the commercialization efforts for Sunosi. The company's significant investment in selling and marketing expenses, totaling $440.4 million, reflects its focus on promoting this product. Additionally, license agreements and royalty payments also contribute to revenue growth or decline. However, these factors are not as prominent as product sales in driving revenue changes. Furthermore, the company's reliance on loan agreements with Blackstone and Hercules Capital, Inc., has significant implications for its financial statements, including interest expenses and debt amortization. The substantial amount of debt, totaling $434.8 million as of December 31, 2025, also affects revenue growth or decline. The company's net loss of $183.2 million for the fiscal year ended December 31, 2025, highlights the challenges it faces in managing its finances and achieving profitability. Overall, Axsome Therapeutics' revenue growth or decline is driven by a combination of product sales, commercialization efforts, debt management, and financial obligations. Net income and profit margins have undergone significant fluctuations over the years. Initially, net income declined due to reduced revenue from third-party payers, page 33. This trend continued with a decrease in net income on page 35, attributed to increased Medicaid rebate liability, reduced Medicare payments, and decreased reimbursement for the $340 billion program. The company's financial struggles are evident in its net loss of $183.2 million, reported on page 42. The decline in net income persisted from 2024 to 2025, with a decrease of $104 million, page 108. Profit margins also suffered due to decreased pricing and reimbursement levels, page 33, and increased costs from ACA provisions, and reduced revenue from the individual mandate elimination, page 35. The primary reasons for these changes are uncertainty in healthcare reform measures and regulatory changes. The company has been impacted by increased Medicaid rebate liability, reduced Medicare payments, and decreased reimbursement for the $340 billion program. Furthermore, it has incurred significant operating and net losses since inception, with expectations of continuing to incur substantial expenses and operating losses. The financial performance of the company has been under scrutiny due to its inability to generate positive operating cash flow. According to the provided information, the company experienced significant losses in both 2024 and 2025. In 2024, it reported a negative operating cash flow of $128,410, while in 2025, this figure increased to $93,405. These numbers indicate that the company is struggling to generate sufficient revenue to cover its operational expenses, resulting in a net outflow of cash from its core business activities. The company's debt level has undergone significant changes over the past year. Initially, a loan agreement was established that provided for loans up to $570 million. However, despite this increase in available debt, total liabilities actually decreased by $90,027 from 2024 to 2025. Furthermore, long-term debt saw a decrease of $44,565 during the same period. In contrast to the fluctuations in debt levels, interest expenses have remained relatively stable. The net interest expense for both 2024 and 2025 was reported as $6,557 and $6,569, respectively. Additionally, when considering the absolute values, interest expense was $6.6 million for both years. Although there is a minor discrepancy in one of the reports, it can be concluded that interest expenses have not changed significantly from one year to another. The performance of various segments and regions has been analyzed, revealing areas that require improvement. The United States segment struggled due to inconsistent policies among third-party payers, hindering coverage and reimbursement. International markets also face challenges, with potential future restrictions on coverage and reimbursement looming large. In addition to these concerns, international markets have already experienced poor performance, largely attributed to strict price controls and diverse reimbursement systems. These factors have contributed to the underperformance of these regions, highlighting the need for more effective strategies to address these issues. Management's outlook on the company's strategy is centered around commercializing its existing product candidates while developing new ones through partnerships. The significant financial losses reported in 2025 are largely attributed to research and development expenses, as well as selling and marketing efforts for SUNOSI. Despite these costs, management remains committed to advancing its pipeline of products, including AUVLITY, SUNOSI, and SYMBRAVO. The company's substantial debt of $1.2 billion as of December 31, 2025, is a notable concern that will likely impact future financial performance. However, management appears to be focused on leveraging partnerships, such as the one with Pharmanovia, to drive growth and mitigate these costs. Overall, Axsome Therapeutics' strategy emphasizes continued investment in research and development while navigating its significant debt burden through strategic partnerships. The company has made significant acquisitions in recent times, expanding its portfolio of products and services. In May 2022, the company acquired SUNOSI solriamfetol from Jazz Pharmaceuticals plc. This acquisition marked a major milestone for the company as it added a new product to its offerings. In addition to this, the company also acquired the ex-US rights to SUNOSI, excluding certain Asian markets, from Jazz in November 2022. This move further solidified the company's position in the market and provided it with greater control over the distribution of the product. On the other hand, there have been no divestitures mentioned in the extracted summaries. The company has focused on expanding its portfolio through acquisitions rather than selling off existing assets. The company's financial activities reveal a mixed picture when it comes to shareholder returns. On one hand, the company has engaged in share buybacks, indicating a willingness to return value to its shareholders through non-dividend means. However, on the other hand, there is conflicting information regarding dividend payments. Some sources suggest that dividends have been paid, while others indicate that no cash dividends have been declared or paid, and that the company does not anticipate doing so in the foreseeable future. This discrepancy highlights the complexity of the company's financial strategy and its approach to shareholder returns. Concerns about inventory buildup or supply chain disruption are evident in various sections of the document. One major concern is the reliance on third-party service providers for critical functions such as warehousing and inventory control, distribution, government price reporting, and customer service. This creates a risk of supply chain disruption if these providers fail to perform satisfactorily. Additionally, there are concerns about potential delays in development and commercialization due to manufacturers' inability to produce products in required volumes on time. Tariffs imposed on imports from certain countries also pose a threat to the company's ability to commercialize products. Furthermore, extreme weather events, natural disasters, and changes in manufacturing partners or suppliers can disrupt supply chains. The document highlights several other risks that could impact the company's supply chain, including production shortages due to raw material supply or manufacturing capabilities abroad, parallel importing, challenges enforcing contractual and intellectual property rights, and unexpected changes in tariffs, trade barriers, and regulatory requirements. These concerns suggest that inventory buildup or supply chain disruption may be a significant risk for the company. That concludes the financial summary for Axsome Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.